Hello, and welcome back to Explain the Charts, your go-to channel for no-nonsense technical analysis and market news. Today, on November 6th, 2025, we're diving deep into one of the market's giants, Microsoft, ticker symbol Microsoft. The situation with Microsoft is incredibly fascinating right now, with a mix of stellar fundamental news clashing with some concerning price action. We're going to break down the latest headlines and then see what the charts are telling us about where Microsoft could be heading next. First, let's cover the recent news, which is the main driver of the current volatility. Microsoft recently reported its fiscal Q1 2026 earnings on October 29th, and on the surface, the numbers were a massive beat. The company posted earnings of $4.13 per share, smashing estimates of $3.67. Revenue also came in strong at $77.7 billion, comfortably ahead of the $75.3 billion forecast. The real star of the show was their cloud segment, with Azure revenue surging an incredible 40% year-over-year. So, with such blockbuster results, why has the stock been in what news outlets are calling a losing streak? The primary reason was the company's forward guidance for the next quarter. Microsoft projected revenue around $80.05 billion, which was essentially just in line with Wall Street's expectations. For a premium, high-growth stock like Microsoft trading at a high P/E ratio, simply meeting expectations isn't enough. The market wanted a significant guidance raise. This disappointing result immediately sent the shares tumbling in after-hours trading. Adding to the complexity, the company disclosed a $3.1 billion loss from its investment in OpenAI. They also highlighted significant capacity constraints due to the overwhelming demand for AI services on Azure. While this signals incredible demand, it also means Microsoft has to ramp up spending on infrastructure, with capital expenditures guided to be over $30 billion. These rising capex concerns, combined with some recent insider selling and the weaker guidance, have created a headwind for the stock despite the fantastic core business growth. Now, let's see how this narrative is reflected in the price action on the charts. Here we are on the daily chart for Microsoft, looking at the action over the past year and a half. We can clearly see a powerful uptrend that culminated in an all-time high of $555.45 back on July 31st. That peak was triggered by a massive earnings gap up, but the stock couldn't hold those gains and has been in a corrective phase ever since. The $555 level now stands as the key long-term resistance that the bulls will eventually need to conquer. After hitting that high, the stock pulled back sharply, establishing a significant swing low around the $495 level in early September. That $495 area is now a critical support level to watch. The price then spent September and most of October grinding its way back up, forming a bit of a flat base or consolidation pattern. It managed to rally all the way back to the $541 to $545 zone just before the most recent earnings report. That area now acts as another layer of formidable resistance. And this brings us to the recent action, which shows a very different picture. Let's zoom in on the period from August onwards to get a clearer view of this consolidation and subsequent breakdown. The large red candle on October 30th shows the market's immediate and decisive rejection of the earnings news. The price gapped down from its close of $541 and has struggled to find its footing since. Currently trading around $507, the stock is sitting just above a minor support zone. The key takeaway from this long-term view is that the primary uptrend has stalled, and the stock is now in a battle between major support and resistance levels. Now let's switch to the 1-hour chart to analyze the short-term trend more closely. Here you can see that post-earnings drop in stark detail. The price plummeted from the $540s and has been making a series of lower highs and lower lows since. This is the definition of a short-term downtrend. The stock has been attempting to base around the $506 to $508 area over the last couple of sessions. This $506 level is our most immediate and critical short-term support. A break below this would likely open the door for a retest of that major daily support down at $495. On the upside, Any rally will face its first test of resistance around the $515 level. This was a support level that failed and will likely act as a ceiling on the first attempt. A break above $515 would be the first sign of a potential short-term trend reversal. For an even more granular view, let's look at the 15-minute chart for the last couple of days. We can see the intense battle happening right now around this $507 pivot. Notice the volume spikes on the down moves, indicating that sellers are still active and present. The price is currently trapped in a tight range between roughly $506.50 on the low end and $510 on the high end. A decisive break of this range will likely dictate the direction for the rest of the week. Bulls want to see the price reclaim $510 and hold above it to build momentum. Bears are looking for a break of the $506.50 low to initiate the next leg down. The price action here is very tight, suggesting a bigger move is coiling up. So, let's go back to the daily chart and put it all together. On one hand, the bullish case for Microsoft is fundamentally rock solid in the long term. Their dominance in AI and continued explosive growth in Azure are powerful tailwinds that are hard to bet against. From a contrarian perspective, this pullback could be seen as a buying opportunity, as the stock is now well off its all-time highs. For the bulls to regain control, they absolutely must defend the $495 to $500 support zone. A decisive reclaim of the $525 breakdown level would be a very strong signal that this correction is over. On the other hand, the bearish case is driven by short-term sentiment and technicals. The market is clearly concerned about valuation and rising costs, and the price chart reflects this. The stock is in a short-term downtrend and has lost key support levels. If the immediate support at $506 fails, a test of $495 seems almost inevitable. A break below $495 would be a major technical breakdown, potentially leading to a much deeper correction towards the $460 to $470 area, which was a key pivot point earlier this year. So, to recap the critical levels we're watching, immediate support is at $506, with major support at $495. Resistance lies at $515, $525, and then the pre-earnings highs around $545. Based on the current momentum and post-earnings weakness, I believe a test of the $495 support level has a high probability, let's say around 60%. For this to happen, we'd need to see the current $506 support fail convincingly on higher than average volume. The probability of the stock reversing course and breaking above $525 from here in the short term feels lower, perhaps only 15%, as it would require a significant shift in market sentiment. The most likely secondary scenario, about a 25% probability, is continued consolidation in this $500 to $520 range as the market finds a new equilibrium for the stock. Keep an eye on the broader tech sector sentiment and any news regarding capital expenditures or AI monetization. The price action around these key levels in the coming days will be extremely telling. Remember to manage your risk accordingly. Finally, please remember that this video is for informational and educational purposes only and should not be considered financial advice. Always conduct your own research and consult with a financial professional before making any investment decisions.